Hello? I'm on my way. One of the biggest developments in the investment industry in recent years has been the growth in popularity of passive investing. Instead of paying to have their money actively managed, investors are increasingly opting for index funds, which are considerably cheaper. Hi, how are you? And aim to capture the returns of an entire market by tracking an index.
Yeah, the term passive investing, I think it's not a very good term for most people to understand, because it sounds like you're standing in the corner, or you're not participating, or you're somehow missing out. And that's that evokes emotions, negative emotions. I like to call, rather than call it passive investing, I call it smart investing, the kind of no regrets investing, where I've minimised the moving parts, I've minimised the decisions I have to make, I've minimised the cost, and I've maximised the chance of me getting the returns from capitalism, which are there for the taking. A passive portfolio can go down just as well as it can go up. And people talk about when stock markets are racing, that's great, but what about when they fall? Well, active funds fall, if not the same, if not more, because of the bets that they're taking. But I think rather than use the word passive, let's use the word smart investing. And what is smart investing? Smart investing is minimising the moving parts and maximising the chance and the amount that you're going to get from participating as an investor in capitalism.
Broadly speaking, the case for passive investing is based on two related market theories, the random walk and the efficient market hypothesis.
The random walk hypothesis is really crucial for investors to understand. It in essence says that the current price includes all the information we currently know and actually the impact of that information on the future. And so what that really says is now the change in price in the future has to do with new information that is random and unpredictable by definition. Nobody knows tomorrow's news. So efficient markets has to do again with this idea that all the known information and news is currently embedded in the stock market prices. And the real implication of that is that prices are fair.
If you agree that markets are mostly efficient and that future price movements are unpredictable, index funds are the logical choice. But the biggest advantage of using them is the cost. You could buy an index fund for about 20 basis points. That's another way of saying about 1/5 of 1%. For an active fund, you could be looking at management fees of anything between 75 to 100 basis points. But with transaction fees, costs, and additional charges, you could easily be paying up to 200 basis points. That's 10 times the cost of an index fund. Over the course of an investing lifetime, that can make a huge difference.
We talk about the power of compounding, and of course on the positive side, the compounding of investment returns is great, but costs also compound, and they compound to the negative side. So the bigger the costs, the bigger the negative impact on the ultimate investment value over time. I like to think about this in terms of what proportion is my costs of the total investment return that I get. Because in days when we achieved 20 to 30% returns in our market, it was almost easy to absorb 2 to 3% costs. But where we are now, single-digit returns, suddenly those 2 to 3% returns are a big chunk out of the ultimate investment return that you compound over time. And that's why costs are even more important in a low-return environment.
Cost is really the only known when investing. You know what you're going to pay, you don't know what you're going to get. We've done work both locally and globally, and the thesis holds true for both. In the local market, there's a very clear relationship between the amount that you pay for investment and the subsequent performance. The lower the cost, the better the subsequent performance has been.
In the US, there have been huge outflows of money from actively managed funds and into low-cost index funds. In South Africa too, more and more investors are now choosing to take the passive route as concern grows about the performance of active managers and the industry's unwillingness to introduce lower, more transparent fees for active funds.
Finally, what does the world's most famous active investor, Warren Buffett, make of index funds? He loves them.
In his February 2017 letter to Berkshire Hathaway shareholders, he was hugely critical of active managers, hedge fund managers in particular, and of the fees they charge. Both large and small investors, he said, should stick with low-cost index funds.